Welcome to this short video. This video is a presentation on the Nigerian tax law. So I'll be walking you through special aspects of the Nigerian tax laws. Many people are concerned about how this new law is going to affect their income. Companies are also concerned about how the new law is going to affect their income. For this short video, I'll be showing you some aspects of the Nigerian tax law, the old law, and the amendments. So if you are looking at the tax law in totality, it's not as if there are new laws per se, but there are amendments and just a few changes to some of the tax rates and how tax will be collected, and also change of name for the Nigerian Revenue Services, formerly known as the Federal Inland Revenue Services. We assume zero knowledge, assuming you are not a tax professional or an accountant. So what is taxation? It's just a compulsory levy by the government, whether states, local or federal governments, on individual businesses or other entities. So basically, the government imposes taxes on goods, on services, on income. And you are expected to pay as a citizen of Nigeria. Now, we have types of taxes, the direct and indirect taxes, but I'm not going to bother you with that. Now, the Finance Act of 2025, which takes effect from January 2026, tries to explain the rationale for some changes in the tax law. And the basic rationale here is that the tax authority or the government is trying to ensure equity, fairness, amongst others, and also to support small businesses and low income earners. I think that is the major direction of the new tax reform. Under this reform, several existing tax legislation, such as the personal income tax, the company income tax, value-added tax, and the capital gain tax were amended. So the rates of some of these taxes are amended, and there are some other amendments to these taxes. So let's look at some of the other aspects, the key reforms. The first has to do with value-added tax and withholding tax. So for the withholding tax, there is no reform. But early this year, 2025, the rate was changed to 2% for some essential services instead of 5%. But under this 2025 tax reform, for the withholding tax, there are no really changes in the rates. But for the value-added tax, before now, or the current tax law does not allow impute VAT for service-based company. So you only claim impute VAT if your company is into manufacturing or sales of goods. That's you purchase goods to resell. But if you are into servicing, you are not expected to claim impute VAT under the current tax law. But the new tax law has created that provision even for service companies to be able to claim impute VAT. Then also, there's the mandatory e-invoicing. All companies are expected to comply to this e-invoicing. For digital companies, they are also expected under this new tax law to charge VAT and also to remit same to the Federal Inland Revenue Services, which is now the Nigerian Revenue Services. For small companies, they are exempted from paying of VAT, which is value added tax. Then how does it affect personal income? So we know that the personal income tax is also amended, and the rate ranges from 0% to 25% on a gradual scale, depending on how much you earn. Under the current tax laws, if you earn minimum income, you pay minimum tax of 1% of that minimum wage. But under the new tax law, those that earn below 800,000 annually are not expected to pay tax. They are exempted from tax completely. Also, looking at the company income tax, there are some adjustments also or amendments. The first is loss relief. Under the current regime, you can carry your loss relief for a maximum period of years, which you cannot go beyond. But under this new law, it is what's indefinite. You can carry your losses indefinite till you claim the total amount there. Now we have the development levy, replacing educational tax, police trust fund, and all other taxes. So it is being consolidated into one, which is the development tax. Minimum effective tax rate rule, 15% for large organizations. And we also have the capital gain tax. It has been increased from 10% to 30%. Taxable income. One is employment income. If you are in regular employment, you are working in a company, your income will be subjected to tax. You have a business, the tax base will be what? Your profits from that business. You have an investment in form of shares, in form of bonds, in form of property, landed property. The returns that you get from that investment will be subject to what? To taxes. Then capital gains. You bought a land today. In 3 years' time, the land is, you bought it today 2 million. In 3 years' time, the land has appreciated to 5 million. If you sell that land today, you are going to pay capital gain tax for that appreciation. Or you bought shares in the stock exchange, 500,000. Every year you are receiving dividend. But the day you decide to sell the shares, the share you bought for 500,000, if for any reason you sell it above 500,000, you have made a gain on that capital. So there's an appreciation on the share price. So that is subjected to tax under the Nigerian tax laws. So there are other taxes, but I'm just going to focus on just these few selected areas. So now personal income tax, which is the PIT. Personal income tax is the tax charged on all incomes of individual. So personal income tax has to do with individual, that is employee, business owners. So if you have a business that is not a limited liability company, that has a business name, you are going to be charged under the Personal Income Tax Act. Professionals and trustees. So after allowing for approved relief and deductions under the tax laws. So your income, there are some, if you are an employee of a company, there are reliefs that you are expected. If you are running business, there are deductible expenses that you are going to be allowed to deduct from your revenue to arrive at what? Your taxable income. In Nigeria, this particular tax is governed by the Personal Income Tax Act, Law of the Federal Republic of Nigeria, 2004, as amended. Now, the Nigerian law, whether the old law or the new law, taxation is based on residence, not nationality. So being a citizen of Nigeria does not automatically mean that you are going to pay taxes in what Nigeria, but your residency is what will determine where you are going to pay tax or who you are going to pay your taxes to. In a short while, we are going to look at residency, what does it mean, and how is it determined. Personal income tax falls under two broad categories, which has to do with one, the employee, then two, the self-employed or business owners. So these are the people that falls under this category of taxes are expected to pay tax under the Personal Income Tax Act. So this is a comparison between the new and the old. The old rates under the old or the current regime, because the new regime will start sometime next year, 2026. Your first 300 will be taxed at 7%, the next 11%, 15, 19, 21, and 24. So it's between a graduate scale of 7 to 24%. While for the new law, it's from 0 to 25. So the maximum you can pay under the Personal Income Tax Act is 25%. So this is the payee tax table under the old and the new. So now let's look at, we've seen the difference in the rates. So let's look at the difference in the reliefs. Under the current law, we have the Consolidated Relief Allowance, the CRA, which is higher of 200,000 or 1% of gross plus 20% of gross, meaning that you compare 1% of your gross and 200,000, whichever is higher, plus 20% of your gross, that becomes your relief. So let's assume that an employee earns 5 million. Okay? The gross of the employee is 5 million. So the relief will be 1% of 5 million, which is 50,000, or 200,000, whichever is higher. So 200,000 is higher than 50,000. So you pick 200,000 plus 20% of gross. And 20% of 5 million is what? 1 million. So you have 200,000 plus 1 million. That gives you 1.2 million as the relief under the current law. For the new tax law, introduced the rent relief, which is 500,000 or 20% of rent paid. So let's also assume a 2 million gross. Sorry, let's assume 2 million annual rent paid. So 20% of that will be 400. Compare with 500. So you pick the lower figure. So since the rent paid is 2 million and 20% is 400, that means the relief the employee will be entitled to will be what? 400. But if the rent paid were to be, say, 4 million, and 20% of 4 million will give you 800, 800 will be higher than what? 500. So you pick the lower. Under that scenario, the lower will be what? 500,000. So this is the relief that is available under the old or the current, let me use it, the current law and the new law. So looking at the table, comparing the new rates and the old rates, let's assume an employee earns 5 million. Just like what I explained in the previous slide. The relief will be 1.2. But under the new law, the relief will be what? 400. So I'm assuming here that because pension and every other deduction, there is no change to those other deductions. Now, what will be the net or the taxable income of the individual if you plug the balance into the tax table? You have 3.8 and 4.6. And payee due under the old will be 704. Under the new, it will be what? 618. So if you do the same for an employee earning 50 million, under the current law, it will be 2.6. Under the old, it will be 2.4. And if you do the same for somebody earning 24 million, payee due under the current law will be 4.4. Under the new, it will be 4.3. So you can see that it's not as if the new tax law is it will make you pay higher taxes based on this analysis. It is targeted at those earning high income, high net worth individuals. So the basic direction of this new tax law is to encourage economic growth by supporting low-income earners, supporting small businesses to ensure that these businesses are able to compete favorably with the larger companies. So that is just the basic of the new tax law. As you can see from the computation, that you are not going to, don't expect that, oh, in the coming year, I'm going to be paying more taxes. But one thing is certain, which the tax authority are driving towards. We said equity, fairness, accountability. Okay, so if currently your company does the right thing, or you as individual, you do the right thing, you don't have anything to worry about or anything to make you get scared. But what they are trying to do is to ensure that tax evasion and tax avoidance, they limit it, they narrow it. That's exactly transparency. That's what they are trying to achieve with these new tax laws. So this is the personal income tax. So another aspect I want us to look at is, yes, some people say that, if you transfer money from the UK, from Canada to Nigeria, you are going to be taxed, and all of that. So is it really true about the new tax law or the current tax law? So there's something you need to understand about the new tax law, which has to do with residency, resident and non-resident individuals or companies. Okay, but let me assume that you are a director in a company in Nigeria and you are not resident in Nigeria, you are a non-resident director. How will your taxes be paid? So for a non-resident director, for director fee, what are you liable to? You are liable to pay just withholding tax on the director's fee, which is 10%. The same under the old tax law. The new tax law also maintain that stand that you pay 10% on director's fee. Dividend from Nigerian company. So you receive dividend, what are you liable to pay? Withholding tax of what? 10% on the dividend received. Salaries from the Nigerian company. So you receive salary from the Nigerian company. Will you be taxed under the Nigerian, what's it called, Peter, Personal Income Tax Act? The answer is no. You will not be taxed under the Personal Income Tax Act because of the rule of what? Residency. For foreign source income, if you are not resident in Nigeria, you are not also going to be liable to any tax. So there's no change on that also. Then if a director returns to Nigeria and you spend more than 183 days in Nigeria, then automatically for that tax year, you are going to be taxed, not just on the income you earn in Nigeria, but on your global income. Any income you received in any country you have traveled to go and work. So long as you have spent 183 days in Nigeria, you are going to be taxed on those revenues, incomes you receive from those other countries, including what you earn in Nigeria. So how do we determine residency? There are 3 basic rules for determination of what? Residency. The first is your physical presence. If you stay in a country, or in Nigeria rather, for more than 183 days in any year, you'll be deemed as what? Residents in that country, in Nigeria for that what? That year. And all your income for the year will be what? Tax. Your worldwide income will be subjected to what? Tax under the Nigerian tax law. The second one is what? Domicile. So maybe you say, oh, now I don't want to spend 6 months in Nigeria so that my worldwide income will not be taxed. And you return to Nigeria, you did 3 months, you did 5 months, and you travel back to the UK, to Canada, to Australia. The second thing that the tax authority will be looking at, so domicile links you to what? Your family ties. Is your children in Nigeria? Is your family, your wife, your spouse, are they in Nigeria? So if that is the case, based on the tax law, it will be assumed that you are what? A resident of what? Nigeria, that you are domiciled in Nigeria because you still have what? Dependents in Nigeria. Then the last one is short visit only. So you visit Nigeria for short board meetings, maybe you are a director, or you are, even if you are not a director, you visit Nigeria for short board meetings or for just short business meeting. You are what? Non-residents. And you are not expected to pay tax in or to the Nigerian government. So suppose you talking about the digital space, freelancer, and all of that how will they pay their tax? So the residency, if you are a freelancer and you're in Nigeria doing your work, or you are doing remote work, so long as you are in Nigeria, I said earlier on that your citizenship does not determine where you pay your taxes, but your residency. So if I'm in Nigeria and I'm doing online services, so long as I'm in Nigeria, I'm going to pay my tax under the personal income tax act applicable in what? Nigeria. So, but if I'm in the UK and I'm doing freelancers, and even I have clients in Nigeria that I work for, I'm not going to be subject to pay tax under the Nigerian tax law, which is the personal income tax laws. So I will be subjected to pay tax under these laws. So in the part 2 of this video, we'll be looking at some other areas of the company income tax that was amended or that has been amended, but to take effect in what? 2026. So if you like the video, you can share it with your friends, drop your comments on the comment section. And if there are questions that you have that you want to ask, you can drop your questions on the comment section, and I'm going to attend to your questions. The Acts or the Gazette is about 200 and something pages. So if you need a copy of the Gazette, you can also just drop your comment on the comment section, and I will share the link with you, and you download the Gazette so that you can make reference to the Gazette at any point in time.